The economy doesn't give warnings. It doesn't send you a letter. One morning you wake up and the rules have changed. The job is gone. The savings are bleeding. And everything you thought was safe, isn't. In the next few minutes, I'm going to show you the 5 financial moves that look smart during good times, but become absolute wealth killers the moment a recession hits. Stay until the end, because mistake number 4 is the one even financial advisors get wrong. Here's what history shows us, over and over again: recessions don't destroy wealth randomly. They destroy wealth predictably. The same patterns appear in 1929, in 1973, in 2008, and in every downturn in between. Most people don't realize that the greatest wealth transfers in history happen during recessions, not after them. The question is, are you on the side that loses, or the side that quietly wins? Let's go through the 5 mistakes that separate the people who survive from the people who never financially recover. In 1929, thousands of Americans woke up one morning to find their bank had simply closed its doors forever. Not just their investments, their savings. Gone. Why? Because they trusted concentration. One bank. One account. One point of failure. What happens next is surprising. Even in the 2008 crisis, people with accounts across multiple institutions and asset types lost dramatically less than those who were fully concentrated. The FDIC limit exists for a reason. Most people ignore it until it's too late. The rule: no single institution should hold more than you can afford to lose in a worst-case scenario. Diversify your deposits, your brokers, and your asset classes before the storm arrives, not during it. This is the most expensive emotional decision a human being can make. During the 2008 financial crisis, the S&P 500 fell over 50%. Millions of everyday investors sold everything, locking in catastrophic losses. Then, between 2009 and 2020, the market returned over 400%. History shows a pattern: the people who held through the Great Depression, through Black Monday in 1987, through the dot-com crash, those who didn't sell, recovered. Those who panicked, didn't. The psychological trap. Selling feels like control. It feels rational. But you're not protecting yourself, you're guaranteeing the loss and removing yourself from the recovery. The market rewards patience, not panic. Most people think their wealth is in their assets. But during a recession, your wealth is in your liquidity. The people who went bankrupt in 2008 weren't always poor. Many had real estate, investments, and retirement accounts. They just couldn't access cash fast enough to cover immediate expenses. When credit tightens and jobs disappear, your emergency fund isn't just useful, it's survival. During the Great Depression, people were forced to sell assets at the absolute worst moment, pennies on the dollar, simply because they had no cash buffer. The standard advice says 3 to 6 months of expenses. History says recession-proof people hold 6 to 12 months of liquid, accessible cash. Not investments. Not home equity. Cash. This one sounds smart. The market is down. Assets are cheap. You borrow money to buy. What could go wrong? Everything. During the early 1930s, millions of investors had bought stocks on margin, essentially on borrowed money. When prices fell, brokers issued margin calls. Investors had to repay loans immediately. Forced to sell into a falling market, they lost it all. Not just the investment. Their homes. Their businesses. The fatal flaw is timing. Borrowing to invest assumes the market will recover on your schedule, before the loan comes due. During a recession, timelines collapse. Recessions last longer than people expect. The 2008 crisis took 5 years to fully recover. Could you service debt for 5 years on falling income? Buying the dip is brilliant. Borrowing to buy the dip in a recession is potentially ruinous. Use capital you own, never capital you owe. Single-income households are recession's easiest target. In 2020, when COVID triggered a sudden economic shock, households with multiple income streams, a side business, rental income, dividends, freelance work, absorbed the blow. Those dependent on one employer, one industry, one paycheck were devastated. What most people don't realize is that building a second income stream during a recession is nearly impossible. Employers aren't hiring. Clients aren't spending. Everyone is trying to survive. The only people who successfully diversify income during a downturn are those who started before it. Recessions punish dependency. The families who came out of the Great Depression stronger weren't the wealthiest ones, they were the most adaptable ones. Multiple skills. Multiple income sources. Multiple options.